Hello, I'm Melissa Wade of Northern State Financial. In this message, Alan Groden discusses international investing with Joe Langella of Philadelphia International Advisors.
A very long time ago, when I was just beginning in the investment business, I can remember meeting with a portfolio manager who specialized in international investments. He introduced the strange and exotic world of international investing. After all, 30% of the world's wealth resided overseas at that time. Fast forward to today, and 70% of the world's wealth is overseas. Virtually every asset allocation, contains international investing. With that in mind, I thought it would be a good idea to invite Joe Langella of Philadelphia International Advisors to give us a better idea of what's involved. Joe, even though it's a foregone conclusion, can you explain why every investor should have some international exposure?
Well, Alan, it's a very good question. We don't think that every investor should have international equity exposure, but certainly any investor that desires or requires long-term equity exposure out the next 3, 5, 7, 10 years or longer should have some sort of international exposure for two very important reasons. The first is opportunity. More than half of all investment opportunities reside outside the United States. So to ignore that large universe of investment opportunities really does the investor a disservice. There are many great companies with great products and services that we use here in the United States. These are companies that are household names. People should not be afraid to own them. They should take advantage of the opportunity to own great companies. The second reason is diversification. We've learned that over the years, to have a well-diversified portfolio, it really requires some exposure to international companies. And what we mean by diversification is that when the U.S. equity market is doing very well, your international exposure might not be doing so well. But when the U.S. market struggles a little bit, then you will rely on your international investments to outperform.
So conceivably, a more volatile investment can make the portfolio more stable.
Well, it can make it more stable, depending on the asset allocation, and also paying close attention to rebalancing your portfolio. So if your international allocations outperformed and done very well, it might now cause your asset allocation to be a little bit out of whack. So in order to get the long-term diversification benefit and reduce volatility, it's important to rebalance your portfolio, take a little bit money away from that outperforming asset class, whether it's international or U.S., and then reallocate back to your original asset allocation.
Interesting, Joe. Now, today we have international managers and global managers. Philadelphia is an international manager. From your perspective, what are the benefits of hiring an international manager?
Well, if you're an international manager as opposed to a global manager, that simply means you're focused only on international companies in their markets. That's the kind of firm we are. We're focused solely on international investments. So we have research analysts, sector analysts, regional, geographic analysts, all focused on international equities and international markets. If you hire a global manager, their focus is on U.S. and international. You're also allowing that global manager to determine what your asset allocation should be between U.S. and international. You may want to have a little bit more control over that. Mm-hmm. You have less control if you have a global manager versus an international manager focused only on international, and then another manager focused only on U.S. or domestic equities. So for those people that want to have a little bit more control over their asset allocation, maybe international is the way to go, U.S. is the way to go, not global, all in one portfolio. Another benefit we think to owning international versus global is that if you have a global manager that might have some portfolio manager turnover or they lose an investment professional or two, then you have two asset classes that have now been negatively affected by some of that turnover in personnel. Mm-hmm. If it happened to an international manager, then only one asset class is affected by it.
Understood. Thank you. Joe, the world's a very big place. How does a firm with a relatively small staff in Philadelphia manage investments all over the world?
Well, that's a great question, Alan. We are a small firm, but not as small as you might think. We have 36 employees, 10 investment professionals, research analysts, and portfolio managers that are researching companies. We are based in Philadelphia, but we do travel. We have regional analysts that cover Northern Europe and Southern Europe, that cover Japan and Asia, that cover the UK, Australia, New Zealand. So we do travel. And in that traveling, we're meeting with companies, their management teams, we're meeting with competitors, suppliers, and even customers. And in this day and age, with technology the way it is, we can get real-time data and information about the companies we're investing in to give us the information that we need to make a prudent long-term investment decision.
Joe, we hear so much about the emerging markets, how fast they've grown. Are they still emerging, or is it one big global marketplace?
Well, I don't think that we're in one big global marketplace, at least not yet. As long as we have different languages and different cultures and different currencies and different economic models and different governments managing economies, we're really not going to have one homogeneous global market. The emerging countries, the most prominent ones, Brazil, Russia, India, China, they've had tremendous economic growth. They're much more stable as economies than they have been in the past. But there's still a long way to go. Some of these economies are not very diversified when you take a look at industry, for example. Russia's very energy and commodity dependent, as is Brazil. We really won't believe that these countries are developed markets as opposed to emerging until their economies become much more diversified and more of their population participates in their economy. And that really isn't yet happening.
Joe, that was a great answer. You said some things that even I didn't know about. I want to thank Joe Langella from Philadelphia International Advisors for joining us today. I think that international investing is something that everyone needs to give serious consideration to. How much and what type? Till next time.